This video is an analysis of how central banks navigate recessionary periods. It also includes inflationary environments given the current stagflation in 2025. It has an emphasis on what fuels an economy to break free of such environments. Recessionary environments can be divided into three categories. Number 1, normal recession. These can be navigated through the changing of interest rates as the volume of private debt in the economy is low, lending institutions have large liquidity, and the cause of the recession is a fast drop in consumption as a result of financial bubbles or others. Number 2, high volume of debt recessions caused by the credit cycle. These can be navigated by a combination of M1 and M2 monetary policies. In this environment, central banks decrease interest rates and purchase private debt to lower risk premiums. In these types of recessions, financial institutions become overleveraged, and their default would remove a large amount of purchasing power from the economy. Therefore, central banks provide liquidity and guarantees to those institutions to restore purchasing power in the economy. Number 3, deep recession. This type of recessionary environment, like the 2020 pandemic when economies come to a standstill, there is a need to use the three levers of monetary tools used by central banks. There's a need to lower rates to stimulate consumption. There is also a need to purchase private debt to lower premiums and provide liquidity. There is also the need to provide money directly to consumers with directions on how to be spent. This will help restore consumption in the economy. The main economic drivers in an economy are productivity growth, the short-term debt cycle, and the long-term debt cycle. Productivity growth is the most important factor over the long term because it does not fluctuate, it makes nations more competitive, and it raises citizens' living standards. On the other hand, credit creates economic swings because it allows individuals to consume more when their productivity has not increased. When credit must be repaid, it forces borrowers to consume less and causes an economic contraction. These increases and decreases in purchasing power is the reason the business cycle expands and contracts when central banks decrease and increase interest rates, as it has a direct influence on how much people can consume. Before proceeding, it is important to present a different way of interpreting the business cycle. This will make it easier to understand the mechanics of how economies can navigate recessions, how economies can drift toward inflation, and what can be used as an indicator that the economy has recovered. The Federal Reserve of St. Louis presents the business cycle as a series of expansions and contractions with real GDP as the vertical axis. This graph shows the cyclicality of the economy, but it fails to expand the understanding behind the forces of contractions and expansions. It also does not show when economies enter an inflationary environment or at what stage an economy begins to overheat and for what reason an economy overheat. The following graph does a good job at presenting the business cycle in a more mechanical fashion. It can be used as a source of reference for understanding how economies navigate through recessionary environments. The business cycle vertical axis can be interpreted as a function of GDP and productivity, which lets us know that the economy expands when it becomes more productive and produces more. Furthermore, there is a ceiling to how much products and services an economy can produce. The graph also shows that an economy reaches an overheating level when it is near its maximum production capacity. If the economy reaches its maximum production capacity and liquidity continues to be infused, the result will be inflation because demand would have outpaced the economy's capacity to produce. An economy reaches a limit to how much it can expand because it is constrained by its citizens' capacity to produce goods and services and the rate at which innovation can accelerate the productivity rate. In normal recessions, monetary policy M1 is highly effective because the volume of private debt in the economy is low, interest rates are not too low, and critical financial institutions are not at risk. The imbalance between the amount of money and the need for it to service debt can be rectified by reducing interest rates enough to produce a 1. Positive effect on wealth. 2. Stimulate economic activity. 3. Ease debt service burdens. In the 2001 recession, when the central bank reduced the federal funds rate, it led the bank prime rate to decrease below the level at which the federal funds rate stood at the time of the decrease. If the majority of actors in the economy are scared as the central bank lowers the federal funds rate, the bank prime rate would remain high because borrowers would demand higher compensation for lending money. The 2001 recession did not create large panic among the population. Therefore, the recession was short. The economy surfaced from the recession in Q4 of 2001 when the productivity rate rose above the federal funds rate and the prime rate. In other words, the economy ability to produce had risen above the cost of production. In a debt market event, the volume of private debt in the economy reaches an unsustainable level that when interest rates increase it leads to defaults across the economy. This is what happened in the 2007 recession in the United States. Debt market recessions are dominated by deflationary forces of debt reduction, defaults and debt restructuring. As a result, austerity becomes a default behavior. As consumers default to austerity, it makes the central bank's job harder because even when stimulative policies are adopted, consumers are reluctant to spend. It is important to note that deep austerity doesn't bring debt and income back into balance because it removes spending and income from the economy. As the economy contracts, government revenue falls because there is less spending and therefore less taxable income. At the same time, demand for government assistance increases. As a result, government deficits typically increase because of the need to recapitalize lending institutions and provide guarantees. In the 2007 recession, the central bank infused over $1 trillion by buying private debt and other financial assets in order to provide liquidity and lower risk premiums. When central banks buy private debt, the money given to private agents is used to buy riskier assets, which helps bring risk premium down to create a wealth effect and restore consumption in the economy. Central banks navigate these economic environments by providing the right amount of stimulus that neutralizes deflationary trends like credit market collapse. The stimulus infused into the economy should stimulate economic activity enough to get the nominal growth rate above the nominal interest rates to relieve debt burdens, but not so much that it leads to a run on debt assets. As we can see from the 2007 recession graph, once the productivity rate rose above the federal funds rate and nominal interest rate in Q2 of 2009, the recession was under control. The stimulative policies infused by the central bank provided sufficient economic activity for the productivity rate to rise above the cost of production, similar to the 2001 recession. Once the productivity rate in the economy rises above the cost of capital, the economy is back to good health. The stagflation environment in 2025 began with the 2020 pandemic. The pandemic brought the economy to a halt because there was no cure at that moment, and it was a very infectious disease. The central bank quickly used M1 policy to lower interest rates and stimulate the economy. Given the severity of the economic environment, the central bank also deployed M2 policy by engaging in the purchase of private debt to ensure the economy had enough liquidity. Given that people couldn't go to work or get near others, the central bank also deployed M3 policy. The Treasury departments provided money to citizens after it was authorized by the government. The result was that too much capital was infused into the economy, and in 2021 inflation increased because demand outpaced the economy's ability to produce. By 2022 the inflationary environment transitioned from inflation to stagflation, which is defined as prolonged inflation with stagnant growth. As of early 2025, the inflation rate remained above the Fed target rate of 2%. To better understand the stagflation environment of 2025, it is important to understand the similar environment of the 1970s. The stagflation environment of the 1970s provides a similar observation of economies emerging from recessionary environments. The economy would have come out of the inflationary environment in 1978, but the oil crisis caused by the Iranian Revolution dragged the economy back into a deeper inflation. The oil crisis caused the inflationary environment to worsen, and it would not be brought under control until 1983, when the economy productivity rate rose above the federal funds rate. In other words, when the economy was able to produce enough to meet demand, inflation dissipated. Inflationary environments occur when there is too much money in the economy, which leads demand to outpace supply. When the economy reaches its maximum production capacity and there is lots of capital in the economy following fewer goods, prices will rise to absorb the large amount of money. Looking at the 2022 stagflation environment as of early 2025, the productivity rate is still below the federal funds rate and prime rate. Using the 1980s as an example, once the economy productivity rate rises above either the federal funds rate or prime rate, the economy production should be able to match demand, and the inflationary environment should begin to dissipate. Until then, increases and decreases in inflation is normal. It is also normal for the central bank to pause and increase interest rates until the economy productivity rate rises above the federal funds rate or the prime rate.